This week, we got the first hint of a softening labor market and some hints of recession spread throughout the week. But somehow, SPY still managed to stay green, inching up from 408.85 at the beginning of the week and closing the week at 409.19. So how did we get here? This all started on Monday with OPEC Plus cutting 1.66 million barrels per day, and this ended up sending oil futures up by 6% just Monday alone. And there's a few reasons as to why this could be. The obvious reason is that we are going into a recession, and whenever we go into a recession, there's less oil that's needed. So they're cutting barrels of production of oil in anticipation of going into a recession in the near future. The second theory is that OPEC Plus wanted to send a message to traders and investors that are toying around in oil futures and burn the shorts. And finally, the third one is more political, and this could be a strong arm against the U.S. government and how we've been draining our SPR, or our Strategic Petroleum Reserve, and we were supposed to start refilling it under $75 a barrel, but we never ended up doing that. And now OPEC Plus just sent oil above $80 a barrel. So now we've lost our chance to refill the SPR. Also on Monday, you had the ISM manufacturing PMI coming in lower than expected at 46.3 versus 47.5 and down from 47.7 at the last reading. And this is the fifth month in a row that this reading has come in below 50. And anything that's below 50 is generally seen as negative. That means that manufacturing purchasing managers are pulling back and they're more pessimistic about the future, which means that we're going to have less manufacturing going on. We're going to have less supply. So if we have the same amount of demand, then inflation is going to be sticking up. But this could be in anticipation of an upcoming recession in the future, and maybe that's why they're pulling back on manufacturing instead. But you can have both. You can have inflation and a contracting economy at the same time, and this is what's known as stagflation. I think that stagflation is the likely scenario over the next maybe 6 months or so, and then past that, the next 6 to 18 months, I think that we're almost guaranteed go into a recession. But that's just my thoughts. When do you think we're going to go into a recession? Or do you think that we're going to miss a recession overall? On Tuesday, though, we got the JOLTS job openings report coming in way lower than expected at 9.931 million job openings versus 10.4 million expected. And this is down from 10.563 million a month ago. So this was shockingly low, and the first signs that employers are starting to slow down on their hiring. But even though it was so shockingly low, we still have a lot of jobs per unemployed person. We still have 1.7 jobs available for every one person that's unemployed. So that means if somebody does end up getting laid off, they can easily find a job because there's so many that are available to them. Another recessionary tale, though, this week was the factory orders coming in negative 0.7% month over month versus negative 0.5% expected. And this is actually a little bit better than negative 1.6% at the last reading for the factory orders. So recession fears are definitely starting to amplify. Gold ended up going up by 2% on Tuesday. The 2-year Treasury yield ended up going down by 8.3 basis points, and SPY ended up dropping by 1% that day. And then on Wednesday, we got a confirmation of the JOLTS job report with the ADP non-farm employment change coming in at just 145,000 jobs added versus 210,000 jobs expected. And this is down from 242,000 jobs added a month ago. So there's a lot less jobs that are being added to the economy right now than just a month ago. And then the services PMI actually was a slight positive to all this recession narrative, coming in at 52.6 versus 53.8 expected. And this is up from 50.6 at the last reading. So this is a slight improvement for services PMI. But this is also telling us that services inflation is here to stick around. We know that goods inflation has slowed down to about 2 or 3%, but services inflation has been around 7% as of the last reading. And the Fed needs to curb inflation overall and not just nitpick one or the other. So it needs to bring down goods inflation and it needs to bring down services inflation. But what was surprising is after the services PMI came out, the ISM non-manufacturing PMI came in worse than expected at 51.2 versus 54.5 expected. And this is down from 55.1 as of the last reading a month ago. So this is a quick deterioration in the non-manufacturing PMI. And Mester confirmed all of our fears by saying that businesses are preparing for an economic slowdown. So Mester kind of added fuel to the fire in this recession fear narrative that we're building. And then on Thursday, we built onto that even more with the initial jobless claims coming in at 228,000 versus 200,000 expected. And this is actually down from 242,000 as of last week. But what's interesting is that last week, this reading came in at 198,000, but they revised this up to 242,000. Now, I don't know about you, but that is a pretty wide discrepancy of about 20%. And this ended up jacking up the continuing jobless claims to 1.823 million people that are unemployed now versus 1.699 million expected. And this is actually up from 1.817 million the week before. And this is the highest unemployment that we've seen from this continuing jobless claims since December of 2021. But what's interesting is that the unemployment rate actually didn't go up at all. We'll talk about that later. But the Challenger jobless cuts came in at 89.7 thousand versus 65,000 expected. So more job cuts than what was expected. And this is up from 77,000 a month ago. And from a year ago, this is up by 300%. But that's kind of obvious. We were hiring like crazy a year ago because interest rates weren't going up. And now that interest rates are at 4.75 to 5% with the Fed funds rate, businesses are starting to pull back. Bullard ended up saying that the monetary policy is tight, but not as tight as it was back in 2008, even though interest rates are actually higher than they were back in 2008. But there's still so much money that's floating throughout the economy, so I can understand where he's coming from by saying that the monetary policy isn't as tight as it used to be. And then Thursday, we had QQQ leading the market, going from bearish to bullish after pivoting around $313, which ended up sending the rest of the stock market up, just like it has since the beginning of the year, where most of this rally has been led by high growth tech names concentrated in about 20 stocks. There was about $2 trillion added in market cap to the top 20 stocks in the stock market versus just about $200 billion added in the rest of the 480 stocks in the S&P 500. So that was the end of the trading week. And then on Friday, Good Friday, was a holiday for the markets, so we had off. Non-farm payrolls, though, came in at 236,000 jobs added versus 239,000 jobs expected. And this is down from 326 jobs added as of last month. So a huge pullback from last month, but it came in just below expectations. And then the unemployment rate again came in at 3.5%, down from 3.6% as of last month, even though the jobless claims was up by about 11%. This means that the unemployment rate should have came in between 3.9 and 4%, but I'm sure next month it's going to be revised up, just like the jobless claims was last week. So we'll see what April has for us, but my guess is that the April unemployment rate is probably going to come in above 4%. So that's what happened last week, and for this week, we've got Fed Williams speaking at 4:15 on Monday, Fed Harker and Fed Kashkari speaking at 4 p.m. and 7:30 p.m., On Wednesday, we have the big CPI inflation report coming out at 8:30 in the morning. This is expected to come in at 0.4% month over month for the core CPI, down from 0.5% as of last month. And then the year-over-year core CPI is expected to come in at 5.6% versus 5.5% last month. And then the month-over-month regular CPI is expected to come in a positive 0.3% versus 0.4% last month. And finally, the year-over-year CPI, the one that everybody's going to be looking at, is expected to come in at 5.2%, down from 6% as of last month. So that will be a pretty substantial pullback in the CPI if that does happen. And if it does meet expectations or beat expectations where we see less than 5.2%, I could see a pretty good rally staging for SPY. That's the big report of the week with CPI, and then the PPI, or the Producer Price Index, is coming out the next day on Thursday at 8:30 in the morning, along with the jobless claims at the same time. So if we look at the Thursday schedule, The core PPI is expected to come in at 0.2% month over month versus 0% as of the last reading in February. And then the year over year reading is expected at 3.3% versus 4.4% in February. So that would be a huge drop in the producer price index, which means that those savings will be passed down to the consumer in the next CPI, which will be really positive for the inflation narrative. We're finally getting rid of inflation if this does come in at expectations at 3.3% or lower. And then the initial jobless claims is expected to come in at 205,000 versus 228,000 last week. So they're expecting a drop in the initial jobless claims, and then for the continuing jobless claims, last week this came in at 1.823 million, but we don't have any expectations for the continuing jobless claims coming up for this week. But if this number does continue to tick higher, then April is going to be a pretty rough month for the unemployment rate. And then finally on Friday, we have retail sales, which is expected to come in at negative 0.3% versus negative 0.1% last month for the core retail sales month over month. Regular retail sales last month was 5.39%, and then the month over month reading is expected to come in at negative 0.4% versus negative 0.4% in February. So that's retail sales for you, and then you have Fed Waller coming in and speaking at 8:45 in the morning, along with the Michigan Economic Report, which is scheduled to come out at 10 a.m. on Friday, where the expectations is 60.9 for the consumer expectations, up from 59.2 as of last month, and then the consumer sentiment is expected to come in at 62.7 versus 62 last month. So we're expecting the consumer to be a little bit more optimistic this month compared to last month, and then the Michigan current conditions is expected to come in at 67.6 versus 66.3, so a slight improvement again. And finally, the 1-year inflation expectations came in at 3.6% as of last month. And if this continues to slow down, then finally, inflation isn't entrenched into the consumer's mind, so this can start to pull back. But the problem with that is if inflation is coming down, we know that our supply chains aren't really improving by much, so it's the demand that's getting whacked that's bringing inflation down. So people are buying less goods, which means that corporate earnings is going to come in worse and worse and worse each quarter after quarter for 2023 and then 2024 if this recession does kick in. So that's all the economic data that's coming out for this week. And then for earnings, I'm looking at a few stocks. We've got Delta Airlines, United Health Group, and then Citi. Delta Airlines is scheduled to report on Thursday in the pre-market on April 13th, where their earnings per share is expected to come in at 32 cents versus 148 as of last quarter, and this is up from negative 123 a year ago. And historically, over the last 8 quarters or the last 2 years, they've done an average of negative 11-cent earnings per share. And then their revenue is expected to come in at $12.05 billion versus $13.44 billion a quarter ago. And then a year ago, they were doing $9.45 billion in revenue. So this is a pretty good increase year over year in their revenue estimates. And historically, they've done an average of $10.06 billion in revenue for the last 8 quarters. So that's Delta Airlines for you and their earnings expectations and what they've done in the past. And then United Health Group is reporting earnings on Friday in the pre-market, where their earnings per share is expected to come in at $6.25 versus $5.34 a quarter ago and $5.49 a year ago. And historically, they've done an average of $5.15 earnings per share for the last 2 years for each quarter. And the revenue is expected to come in at $89.78 billion versus $82.79 billion a quarter ago and $80.15 billion a year ago. And historically, they've done an average of $76.47 billion per quarter for the last 2 years. And then finally, on Friday, you have Citigroup reporting earnings in the pre-market, where the earnings per share is expected to come in at $167 versus $110 just a quarter ago. So a huge improvement for the earnings per share, but a decrease in the year over year from 202. And historically, they've done an average of 214 earnings per share for the last 2 years. And finally, the revenue is expected to come in at $20.08 billion versus $18.01 billion a quarter ago and $19.16 billion a year ago. So slight improvement year over year and quarter over quarter. And their historical earnings per share has come in at $18.29 billion for the last 2 years. So they're expecting revenue to continue to go up quarter over quarter, year over year, and beat their average earnings, which I don't believe is going to be the case. I think that The demand for housing is slowing down, which is going to really impact the top line of the revenue for banks, but Wall Street is thinking the opposite to me. So that's all the earnings that I'm watching for this week. But where are these stocks going to go? Well, let's check out the technical analysis. For SPY, it's expected to be in a range of 401 to 417, with some support levels at 406, 404.35, 403.10, and 401.60, and then resistance at 410, 412.35, 415, and then a Fibonacci retracement at 418.21. Then for Delta Airlines, the expected range is 3170 to 3570, with supports at 3306, 32.35, and then resistance at 34.50 and 35.10. If they end up beating on their earnings per share at 32 cents and then beating on their revenue at 12.05 billion, then I expect their stock to be above 35. If they beat earnings but miss revenue, I expect their stock to stay above 33. If they miss on their earnings and then beat on their revenue, I expect the stock to stay above 32.5. And finally, if they miss both earnings and revenue, I think that it's going to slip below 32. And then for UNH, the expected range is 497 to 530, with supports at 511.50 and 500, and then resistance at 516.74 and 534. If they end up beating their earnings per share at 625 and then beating the revenue at 89.78 billion, then I expect their stock to be above 525. If they beat earnings but miss revenue, I expect their stock to stay above 517. If they end up missing earnings but beating revenue, I expect their stock to be above 506. And finally, if they miss earnings and miss revenue, I expect their stock to be below 500. And then finally, Citigroup, the last stock of the week. The expected range is 43.6 to 48.2, with supports at 45.11, 43.88, and then resistance at 45.88, 46.56, and 47.56. If they beat their earnings at 167 earnings per share and then beat their revenue at 20.08 billion, I expect their stock to be above 47. If they beat earnings but miss revenue, I expect their stock to be above 45. If they miss on earnings but beat on revenue, I expect their stock to be above 44. And then finally, if they miss earnings, miss revenue, I expect their stock to be below 43. So those are the few stocks that I'm watching this week and my expectations and all the data that's coming out. Hopefully you found this video useful. If it was, show some love, leave a like. Thanks for making it all the way to the end, and thank you to all my patrons and my channel members for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.